understanding the bull-put spread, balancing risk and reward in options trading. Picture this. You're an options trader who is bullish on a stock, but unsure how far or how fast the price will move. You also want to minimize potential losses. Enter the bull-put spread strategy. A bull-put spread is a strategy used by traders who expect a stock or index's price to rise or stay steady. To create a bull-put spread, you sell one put option and simultaneously buy another with a lower strike price. This establishes a credit spread because more premium is collected than paid. To keep things manageable, both legs of the spread should have the same expiration date. The sold put option generates income from the premium received. The long put option acts as insurance, capping your potential losses. However, it also reduces the profit of the spread since the cost of the long put offsets some of the profit from the short. Careful strike selection is essential. For the short put option, choose a strike price below the current underlying price to increase the likelihood of the option expiring out of the money. This would result in you keeping the premium you collected when you sold the option. When choosing the strike for the long put option, select a strike price lower than the short put option. This helps mitigate potential losses in case the underlying price drops unexpectedly. Even if the underlying price drops below this strike, your losses are limited to the difference between the strike prices minus the premium received. Select strike prices based on where you think the stock or index could be at expiration. If you expect the underlying to go up or stay flat, choose strike prices below the current stock price. Traders often choose strikes below a support level they expect to hold. To illustrate a bull-put spread, let's use Abercrombie & Fitch Company, symbol ANF, as an example. ANF appears bullish on the weekly and daily charts. The price appears to be bouncing near a support level of around $115, with the potential to move towards a resistance near $140. When selecting the expiration, longer-dated options have additional time value, making them more expensive and possibly offering more profit. Bull-put spreads are credit spreads. The theta is positive, and time decay works in the trader's favor, making the position cheaper if they need to buy to close it before the expiration. Shorter expirations carry less premium but decay at a faster rate. Time decay grows exponentially and increases sharply when there are 30 days or less to the expiry. The increased theta also comes with an increased gamma. This means that the bull-put spread benefits from the time decay, but is at greater risk from premium changes due to adverse price movement. To take advantage of the increased time decay, we are choosing options that have 29 days until expiration. In this example, let's sell the call at the support level, the 115 strike, with a bid currently at $2.35. To manage risk in the position and collect enough premium, we'll buy the 110 strike put with an ask of $1.45. The natural price of the spread is 90 cents, so we will place the limit order at that level. Here is our bull-put spread on ANF. Our maximum profit is $90, the total credit we collected. The maximum risk is $410, which is the difference between the strikes minus the premium collected. The break-even price is the short strike minus the premium, or $114.10. You may have noticed that the maximum risk of $410 is much greater than the maximum reward of $90. Credit spreads are typically like this. Traders used to debit spreads or long single leg options may be turned off by the inverted risk-to-reward ratio. At first glance, a long call option may seem like a better trade because it could potentially have more maximum reward than risk. However, this is not the whole picture. The probability of profit is also a factor. Remember, the bull-put spread can realize its maximum profit if ANF remains above the short strike at expiration. That means the price could move upwards to resistance, increase slightly, stay relatively stable, or even experience a minor decline. The bull-put spread presents a wider range of potential outcomes resulting in profit than debit strategies, which typically require a significant price movement to generate profit. The bull-put spread does have an opportunity risk. If the underlying price rallies above the resistance, the trader would miss out on more potential gains because the profit is limited to the premium received. Volatility also impacts the bull-put spread strategy. Increasing volatility raises the value of options, while decreasing volatility lowers options values. To collect higher premiums, traders would want to enter the bull-put spread when the underlying implied volatility is relatively high and expected to drop. A drop in volatility may lower the premiums of the options. If the trader has not been assigned on the short put, they could close the spread before expiration for a smaller profit by buying to close the short put and selling to close the long put. In our example, we can use TradeStation Pro's price slices to view the effect volatility has on the theoretical price of the bull-put spread. At the current price and volatility, the theoretical value of this spread is $129.25. With the underlying price remaining unchanged and applying a 5% volatility adjustment, the option's theoretical value increases to $143.30, reflecting a $14.05 change. Decreasing the implied volatility by 5% reduces the theoretical value to $113.27, a $15.98 drop from the original price. Should the trader want or need to close the spread, the drop in volatility makes it cheaper, so they could potentially close the spread for a profit. Remember, the theoretical profit is an estimate. It's important to note that the actual profit is not guaranteed to match the theoretical value. If all variables are accounted for, the profit should be close to the theoretical value, but the real profit may differ. The spread can only be closed if the short option has not been assigned. Assignment could happen at any time once the spread is opened. Bull-put spread traders can avoid early assignment if they trade European-style options on the indexes. However, assignments can still happen if the options expire in the money. So, when is a bull-put spread appropriate? It's handy when you're optimistic about a stock's future but want to limit risk. This strategy should also be in your toolbox if you aim to generate income in a sideways or slightly bullish market. In summary, the bull-put spread option strategy offers a balanced approach to trading, generating income while limiting risk. The strategy is used to potentially profit from a stock or index's price rising or staying steady. A bull-put spread is created by selling one put option and simultaneously buying another with a lower strike price. Both options have the same expiration date. The result is a net credit because more premium is collected than paid. The premium collected is the maximum profit for the position. The maximum risk is the difference between the strikes minus the premium collected. The break-even price is the short strike minus the premium. The position benefits from time decay and reduced volatility, leading to a decrease in the option's value. The trader has the option to buy back the position or let it expire out of the money. Furthermore, it's important to consider the potential risk of assignment occurring at any time after opening the spread, regardless of the strategy's outcome. Before implementing the strategy, carefully assess market conditions and risk tolerance. Then, practice it in TradeStation's simulated trading mode to build confidence without risking real money. Be sure to access the downloadable Workspace and instructional PDF, which guides you in using Radar Screen to identify bullish stocks or indexes. Then, learn to integrate TradeStation Pro for effective bull-put spread trading. Explore additional training and elevate your skills by tapping into the comprehensive resources within this option series.